Welcome everybody. My name is Yohay Elam. I'm a Forex Crunch and of Market Movers podcast. I'm going to talk today about euro dollar. What moves euro dollar? What will move it in the future? And this is a more sort of top level presentation. I'll present myself shortly. I used to be a retail trader and a computer programmer. I founded Forex Crunch back in 2008. The site focuses on fundamental analysis. And I touch also on technical, but more on fundamental. I'm the co-host of a relatively new podcast called Market Movers. You're welcome to listen. And we recently began the FX Street Morning Show, a presentation of the new trading day every day at 8 a.m. GMT. Okay, today what we'll cover is, well, the basic facts of euro dollar, really basic, then the long-term influences, the recent movements in the past year or so, the changes in how it reacts to events in markets, and that's really a change from the last few months, and look a bit into the future. And of course, at the end, we'll have a short Q&A session, questions and answers. So, basic facts. Well, euro dollar is the world's most popular currency pair because, well, the US economy is huge, number one in the world, $18 trillion. Then comes the Eurozone economy, and only then China and Japan. So China is the second largest economy in the world if we count individual countries, but if we look at the Eurozone as one economy, it's the second largest. But also in Forex, it's important. It's the most popular currency pair. Nearly a quarter of transactions in the spot market are euro-dollar. And the turnover, when we have two currency pairs, so 87% it's the US dollar and a third it's the euro. So it's very popular. Okay. US dollar is special on its own. United States is the world's superpower, like it or not. And oil prices are in US dollars. That makes movements, of course, very important, has a great correlation. And of course, it's the number one reserve currency. Euro is special as well. It's the monetary union of 19 developed countries, but there's no fiscal union, so there's one central bank, but 19 separate governments. And, well, this is a bit sarcastic. It's not always one big happy family here in the Eurozone, but sometimes we have quite a bit of mess, quite a hard time making decisions. So it also makes things interesting. So lots of trade, lots of countries, makes lots of information, but also lots of noise. So what's the best way to separate the noise from news? Well, trading long-term. And also in technical analysis, we see that when we have breakouts, they're really strong and really big on the weekly charts, monthly charts, daily charts, and less on the hourly charts, or of course not on the 5-minute charts. So here we have, for instance, the big breakdown that we had under 140, and then this very, very long-lasting support line from 2005 that held very well. Twice in the past, it worked in an excellent way as support, and then when it broke down in flying colors. And also you can see other lines. For instance, in 2008, we had this double top over there above 160, and we have the bottom for this year so far, 460. Provided also support back in the past. So I think that news moves markets, and if we want to use technical analysis, we can use it long-term, and in the shorter term, it's a bit more messy. We can try to draw lines. That's what I try to do here, but it's always a bit more messy. Okay, so these are sort of very, very basic facts. I know it's a popular currency pair. Not always the best one to trade, but always very interesting. What are the long-term influences? Well, we have these influences. Real trade means imports, export, people traveling. If I go here from Barcelona to the United States, I have to buy US dollars and the other way around. And each time a German company sells the car to the United States, maybe now a bit less than beforehand with Volkswagen, but there's a transaction of euros and dollars, and the same thing with the goods traveling to both these biggest economies in the world. So let's begin with that, and then we'll talk about interest rates, money printing, and expectations. So real trade. In real trade, euro dollar should be much, much stronger because if you look at a bit at the numbers, 13% of Eurozone exports go to the US, but only 6% of Eurozone imports come from the US. So in general, there's much more goods moving from the Eurozone to the United States than the other way around. Eurozone in general, against all the world, has a surplus of 22 billion every month, and the United States has a deficit of $40 billion. So if goods go in one direction, not the other, it has to be covered by money. But of course, this gap means money is flowing from the United States to Europe in general. And to balance the gap, euro-dollar basically needs to jump. So, but when nothing else happens in markets, no speculation, no interest rate changes and things like that, euro-dollar basically rises because just on the exchange of goods, of money that goes naturally, it goes in one direction, okay? So if there's no news at all, which doesn't happen too much, it's good news for the euro-dollar. But this gap persists, this big trade balance, because, well, other factors have the upper hand because there's always news, okay? So in general, interest rates also drive currencies, but we're in the world post-financial crisis, so we have very low interest rates everywhere. It's sort of an ugly contest of who has lower interest rates. So it's 0.14 in the United States and 0.05 in the Eurozone. But of course, it wasn't always like this. Also, after the financial crisis, we had movements, less in the United States. In the United States, Ben Bernanke cut interest rates to 0%, 0 up to 0.25, and since then, it's been flat zero. Now they're expected to rise. We'll talk about that later, but basically, it's been a flat line. You can see the chart there below. So this chart only goes up to 2011, but it's been exactly the same up to late 2015, up to today, okay? In the Eurozone, we had other things. It was 1%. They cut it to 1% after the crisis broke out. And then in 2011, very interesting year, Jean-Claude Trichet, president of the ECB here on the left, he raised the rates twice because of rise in oil prices. I think that was a huge mistake. It contributed to a second recession here in the Eurozone. And then came Mario Draghi. On the right, he had a different direction. This is the chart of interest rates in the Eurozone. As you can see, it was slashed in the financial crisis. Then right here, this sort of hill, that's the rate hike of Jean-Claude Trichet. And then Draghi cut it, and then further cut it. So it's currently, the black line is the lending rate, 0.05%, and the minus 0.20% on the deposit rate. That means that if a commercial bank parks its money with the ECB, it gets less money at the end. It's basically punished, okay? So now the third factor, quantitative easing or money printing. That's a home printer, and they use bigger ones than this one, but what they call quantitative easing, the idea, economic theory, is that the central bank creates new money and buys long-term bonds. By buying long-term bonds, it lowers long-term interest rates. Okay, so companies, people can plan more ahead, can lend money cheaply, but basically the central bank is creating more money, enlarging its balance sheet. And it can do that. Of course, it risks inflation, but when things are wrong, if you print more money, it doesn't automatically cause inflation. You need to print a lot, okay? So in the United States, we had 3 QE programs, and each time the Federal Reserve made a new program, began buying bonds, and after it ended the program, it didn't undo it. It just, for each bond that matured, it bought another one. So the balance sheet never squeezed, it always went up. They also did in the middle 2 twist programs to change which bonds they buy. It's less important. Basically, the balance sheet of the Federal Reserve always went up. It's you can see here QE1, QE2, and QE3 that ended back in October, and it bloated the balance sheet of the Fed up to 4.5 trillion US dollars. And the Eurozone was different. They began doing these programs only in late 2011, and it wasn't exactly QE. They actually lent money, cheap money, to the banks for 3 years. But when the banks returned this money, the balance sheet squeezed once again. And they only introduced QE this year, in 2015. So this is the balance sheet of the ECB. You can see in 2011 right here, 2012, the LTRO, the lending to the bank, but then it squeezed back down, okay? And QE began only in 2015. And this is also a projection for 2016. Here I mentioned also the TLTRO, which is targeted loans, but basically the same. It's loans to banks. It's not really printing money. It's enlarging temporarily the balance sheet. So that's why, in general, we had a stronger euro-dollar for quite some time. Of course, the fourth factor is speculation, most important one. Central banks also tend to guide markets. They prefer talk over action, and talk is sometimes cheap. And we had this here, a few examples. Sometimes we can see it's too much information, it can be confusing, but many times it worked. So when Bernanke gave an interview, former head of the Federal Reserve, talked about QE3, that of course pushed the dollar lower, pushed long-term bond yields lower. He did that again in Jackson Hole. In 2013, he talked about tapering, and then the US dollar jumped. Emerging markets, stocks there had trouble. Yellen talked in her first press conference about raising rates 6 months after QE is over, and that of course made the dollar jump. That was probably a mistake. And then they guided markets with patience. They're going to be patient before raising rates. So the Fed has its share of buzzwords of causing markets to speculate, and the ECB did more of the same. Jean-Claude Trichet talked about strong vigilance. That was a hint for everybody that they're going to raise the rates in the next meeting. And then Draghi, the most famous move, just before the London Olympics began, he said he'll do whatever it takes to save the euro, and believe me, it will be enough. And that marked the bottom in euro-dollar for 2012. And then he pushed euro-dollar lower in 2014 by saying we feel comfortable to act next month, and indeed they acted. In general, central bankers prefer showing the bazookas, telling markets they can act without acting, and they prefer bazookas over confetti. Here we have a young lady protesting against Draghi and throwing confetti. Nobody was hurt, but it was quite funny. So that's the long-term influences of euro-dollar. Now let's look at recent movements. I'm talking about the past year or so. It has been down. Okay, so these are the moves in the past year. We had a big fall from May 2014 to a bottom early this year, and then some kind of stabilization. So let's see what moved it. We had in May 2014, euro-dollar was almost at 140. We had the balance sheet squeeze. We had lots of, the regular no news is good news supporting the euro. But then Draghi said we're feeling comfortable to act. In June, they were comfortable to act, and they set negative interest rates, a negative deposit rate. It already sent euro-dollar lower to 137. In September, they did a rinse repeat of that move. They lowered interest rates even more, and they began hinting about printing money, about QE. It fell all the way to 126. In October, as planned, the Fed ended QE. That was no surprise. In December, the ECB already began talking more seriously about QE, and that sent euro-dollar lower to 121. Come 2015, we had January was very, very exciting. We had the Essen bomb, the Swiss National Bank, remove its peg, and then the ECB announced that it's printing money. So we had euro-dollar extend its falls. It was huge, all the way to 111. That didn't end there, because in March, QE began smoothly. The implementation began, and the ECB executed it without any problems. In the meantime, the United States, the Fed removed the wording about patience, setting the way for raising rates. We're still waiting for that, of course. And euro-dollar reached a low of 104.60. In April, things began changing. We had the pair bouncing back, and the change in its behavior. We'll talk about that change in behavior shortly. And then it settled in a wide range of 108.10 to 114.60, around 650 pips, and in recent weeks only around between 111 and 113. Okay? And then this summer, we had stronger action in the end of August when everybody was on vacation, including myself. We had the crisis in China. So we had a roller coaster in markets, mostly negative, mostly crashing, and we had euro-dollar swing about 170. Bad news being good news for euro-dollar. We'll explain that shortly. And in September, just 2 weeks ago, the Fed did not hike. They waited once again, and the ECB also did nothing yet. There was talk that they would introduce more QE. So what's next? Now let's talk changes in the reaction mechanism. Basically, I hinted about that, about the rise of euro-dollar and the Chinese crisis. So these two currencies are special, euro and dollar, and they're not the only ones. Let's look at Japan because it's the best example of what is a funding currency. This is what's happening now with the euro. So for years and years and years, Japan had very low interest rates. So it was very cheap to lend money in yen and then to spend it elsewhere on more risky assets. And this included currencies with high interest rates. That was the famous carry trade. Aussie against the yen and the Kiwi against the yen. When you had an interest rate of 8.75 in New Zealand, you can just borrow in yen, and which was around 0.10% or 0.5 interest rate, and just buy New Zealand dollars. And that just earned the interest rate difference. That worked very well until the music stopped, until just the currencies moved in the opposite direction. So the New Zealand dollar crashed in the crisis and the Japanese yen soared. Okay, so that was the carry trade. It worked until it stopped working. After the crisis, what happens in times of trouble? Money comes back home and wasted, spent elsewhere. It came back to Tokyo, came back to Japan. So the Japanese yen strengthened because the Japanese yen is a funding currency. We've seen that in an extreme example in 2011. We had that terrible earthquake, tsunami, and nuclear disaster in Fukushima in Japan. So in this terrible tragedy that hurt the Japanese economy quite a lot, the Japanese yen actually strengthened. Very counterintuitive, but this is what happened. Now, that's funding currency. We have also safe haven. Basically, the reaction is the same, but the background is a bit different. So the Swiss franc has always been, they have peace for 700 years or so. It has been a safe haven. It means if there is trouble, you buy the Swiss franc. If there is no trouble, you sell the Swiss franc. So we've seen that especially in the Middle East in the Arab Spring of early 2011. We've seen money coming to the Swiss franc. Had trouble in the Eurozone, in all the debt crisis, which is a very long story, of course. We've seen money pour into Swiss francs. Trouble in Ukraine, also in Europe, the same thing. Now, that a bit belongs to the past because the Swiss franc is not so safe anymore. Since 2011, that year, the Swiss National Bank made a peg of the euro to the Swiss franc at 120 since September 2011. But this year in January, it broke the peg. This is the guy, the head of the Swiss National Bank, Thomas Jordan. At the time, he was the most hated person in his country. In any case, this was the chart fall of 14% on January 15th this year. Okay, so the Swiss franc is not so safe anymore. So let's look at the United States as a safe haven and the funding currency. It has actually both features. First of all, the United States is the world leader. And for many years after the crisis was the notion that if the United States cannot lead, the rest of the world is probably worse off, okay? So we had this interesting reaction. Yeah, and also it's a funding currency because, well, you had zero interest rates since the very beginning, and all this crazy money printing QE1, QE2, and QE3. Okay, you had so what kind of reaction did we have in markets? For quite some time, we had weak US data and this notion that, okay, if the US is in trouble, everybody's in trouble, the world is doomed, and the US dollar was actually on the rise because the US dollar is a safe haven and money was funded in US dollars and it was repatriated, it came back to the United States. Okay, and when we had good figures in the United States, then we had this good mood in markets, what's called risk on, or it's called risk on, risk appetite. So strong US data, let's take risks abroad and party, and the US dollar fell. The best example of this weird behavior came in 2011 once again, and the S&P Standard & Poor's cut for the first time the credit rating of the United States. This AAA was lost, it turned into AA, and the US dollar reacted positively. It was a safe haven currency. Okay? Now, this has changed because the US is expected to raise rates sometime, at some point. We'll talk about that later. So far, the Fed has been quite dovish. So the US dollar is no longer the best safe haven, the best funding currency. And where does the euro stand? Well, in the past, it just used to be just another currency. So you had good news in the Eurozone, a stronger euro. Bad news in the Eurozone, a weaker euro. Very simple, very straightforward, like most currencies do. These were the good old days, but the times are changing. So, and this is a change from the recent months. This root of this change began with the negative deposit rate back in June, and then another cut in the deposit rate in September. So basically, banks are punished for parking money with the ECB. And the bigger change came when QE was introduced, and more importantly, when the implementation began in March. So it became very cheap to borrow money in euros for many corporations and governments as well, and taking risks abroad. Okay, so euro became a funding currency. So that's what we've seen in August with the Chinese stock market crash. We've seen, well, in general, when stock markets go up, the euro goes down, and when stock markets go down, the euro goes up. We even broke out of that range, out of 114.60, and but this wasn't reached again in a normal atmosphere. So that was the best example. But here we have an even better example. So the euro worked as a funding currency, and the same thing worked for Greece. We had another round of the Greek crisis in June and in July. And each time we had good news from Greece, we had a weaker euro. And when we had bad news from Greece, a stronger euro. The best example was on July 13th, on this all-nighter in Brussels, when Prime Minister of Greece, Alexis Tsipras, and Chancellor of Germany, Angela Merkel, were in one room for 17 hours or so, and reached an agreement. Finally, in theory, good news. And what happened? The euro fell because good news for the euro is a weaker euro. Counterintuitive, but that's what happened. So the euro is a safe haven now, even if this haven is in Pyrrhos, and even if it's in trouble. Okay. So basically, we've seen the US dollar stopped functioning as a reserve, as a funding currency, and the euro changed it. The euro is now a funding currency. So they switched positions. But this battle, not only on the value of euro dollar, but also on the behavior, is far from over. Okay, so let's look from the past to the future. What lies ahead? The big events coming up next week, the week afterwards, October 12th, we have an ECB decision. I think what my best guess tells me is that the ECB will announce that it's ready to act once again, hint that it might act in December, but not do anything yet, wait for the Fed. Then on October 28th, we have a decision by the Fed, but there's no press conference. And then another ECB decision on December 3rd with forecasts. And then the most important Fed decision, the last one for 2015, and maybe finally we'll see it act. Why is that? What am I looking for in the ECB for the ECB meetings? My bet is that they'll hint in October about moving in December, and in December they'll announce extending QE. So the current QE program in the Eurozone is expected to end in September 2016. So they might take the chance to announce that it'll go beyond 2016, until 2017, or until infinity. Okay, so it's basically, but this is basically only forward guidance, only talk, and talk can be a bit cheaper. What the other thing that they can do is change the pace from 60 billion euros a month to 80 or 100 or more. That's really shooting, not only talking. I'm not sure that they'll do that, because I'm not sure there is enough support within the ECB, and I believe that they do wait for the Fed. So in general, if my prediction is correct, and they'll go halfway, only extending QE and not expanding it, then it's basically neutral for the euro because it's priced in. But what's going on for the Fed? Here's Janet Yellen, the chair of the Fed, pointing upwards, and I think that's the way they'll go. I think that in October, they'll hint about an imminent rate hike coming in December and actually move in December. Such a move, even if it'll be hinted, it's a big move. It's historic. They haven't raised rates since 2006, okay? So even if it's a dovish hike, even if they'll hint that it's a one-off, if that the next hike will have to wait for a long, long time, it still is not priced in, and I believe will not be priced in, because markets believe that rates will remain zero forever and ever. So I think it will result in a stronger US dollar towards the end of the year. Okay, that's what I'm looking for. Basically, you can say, why will the Fed raise rates? Okay, because so far US interest rates have been at the bottom, and it looks great for the economy. It's only going up, but actually not exactly. This is not the chart for the economy, it's a chart for the S&P. Okay, so the stock market really enjoyed these zero rates until recently, at least. And this is reality. Okay, so the unemployment rate has been going down in the United States since the financial crisis, since this gray line here. Unemployment rate rose a bit more and then began dropping and dropping and dropping and dropping. But wages that used to rise on a much higher basis, they are not rising so fast. Okay, so wages are rising only at a rate of 2.2%, something like that, in the last month. Quite mediocre. So you can say, why should they raise rates? And here are more reasons. Inflation is still too low. It's not only oil, but it's mostly oil. China is slowing down. Of course, we had crisis in China. The International Monetary Funds and others are warning about what's going on and what will happen. The dark scenarios if the Fed raises rates. In general, Janet Yellen and the Federal Reserve, they're dovish, right? And they don't want to backtrack later. They don't want to raise rates now and then, choke the economy, regret that, and backtrack and cut rates once again. But why do I think they will raise rates in December? Finally, well, first thing, inflation, it lags employment. So first we have GDP growth, then we have rise in employment, more hiring, and then we have inflation. It takes time, this time more than ever, perhaps because of demographics, but the Fed needs to be ahead of the curve to act before inflation is too high, before it will need to tighten too fast. Another issue is the bubble trouble. The Fed has been blamed in the past for creating the bubbles, the dot-com bubble, and of course the housing bubble of the recent crisis. So it doesn't want to create another one. Of course, it's not only the fault, it's not only the Fed is to blame, but you have interest rates for so long, you encourage risk-taking, you encourage buying high-yielding bonds or junk bonds in plain English, so it's a problem. Okay, and recently we're seeing it not really helping the real economy, just stock buybacks. So we have on one side the IMF talking about what will happen if the Fed raises rates, but we have Carl Icahn talking about the dangers of not raising rates. And if you keep these zero interest rates for too long, you're encouraging an even bigger bubble, which means even bigger problems. In general, as I see it, it's time for the Fed to move on. Loose monetary policy is like medicine. It helps a lot, but also medicine has an expiry date. At some point, it makes more damage than good, and I think it's high time for the Fed to move on. So, what's my prediction for the next few months? I believe the euro dollar, at the moment trading at around 112, will reach new lows, perhaps under 104.60, the low of the year, and it can come sooner rather than later. But after the Fed actually raises rates, after it's over, it finally happens, this Godot finally arrives, then a month afterwards, after the dust has settled, euro dollar could actually start a nice recovery. Why is that? Because, well, as I said, the trade between the Eurozone and the United States supports a stronger euro against a weaker US dollar. And once the news is out, it's no more, we could have a buy the rumor, sell the fact. And a stronger US will also show more confidence to the rest of the world that things are getting better. Of course, the Fed needs to genuinely be confident that things are getting better and not just raise rates because it has to do that. Okay, so I think we might have a month of turmoil, a month of stronger US dollar, but then eventually this could more or less mark the bottom for euro dollar. That's my bet. I don't think it will continue falling unless things really deteriorate here in the Eurozone. Of course, there are so many reasons for things to deteriorate here. Greece, elections in Spain, tensions between Germany and France, refugees, Ukraine, you name it. But wait, also the United States has its own trouble. Okay, so that's what I've prepared for you guys today. It's time for questions. What's the next direction of euro dollar that you think we'll see? Let's see where it's trading at the moment. Yeah, just under 112. So while we await your questions, take the opportunity to thank FX Rate for hosting these webinars once again. I've been told that next time we'll have a bit of a different format, but it's basically the same, the same type of content. You're welcome to visit forexcrunch.com and listen to the Market Movers podcast. Here, the contact details are here on the screen. You're welcome also to download the mobile Android and iOS apps for Forex Crunch. And I'm looking forward to your questions. Please put your questions in the chat box and not anywhere else. I know in WebEx there are quite a few boxes, so here are the charts. I guess you guys liked that joke. Can't remember which one it was, but do you guys trade euro dollar or prefer other pairs? I just published on my website an article about the 5 most predictable pairs for Q4. Euro dollar is the bottom of the list. I prefer the Kiwi dollar, the Australian dollar. They have much more directional moves and less choppy. I mean, also for the short term. From where are you? Question from MRNC. From where are you short euro? Well, I'm not going short, but just that's my prediction. Currently, the range is 108.10 to 114.60. We're around the middle of the range. So, in general, I don't provide signals, but I think there's more room on the downside than to the upside. We're stuck in range trading and it depends on the fundamentals. If you look at the charts, you don't have any clear direction. So I would say 114.60 is a strong level, and then the downside 108.10 and then 104.60. On the upside it's 117, but I see that more as a swing high. Another question, waiting for dollar strength to show up. Yeah, we're all waiting. So yeah, you mean Pan means getting out of consolidation. Yeah, we're seeing this pair consolidating for quite some time. For those of you watching the morning shows, we're talking about this 111 to 113 range, which is a bit frustrating, and too many movements related to stock markets and less to central banks. I believe that later in October it'll change, and attention will be even much higher towards the decision in December. I can mention on the shorter term, tomorrow we have the non-farm payrolls, and it's supposed to show around 200,000. So very, very steady, in line with previous months. If it's around these numbers, we'll look at wages. I can show you the wage chart once again. Let's see that. So it's quite frustrating. Wages haven't really gone up, and maybe we'll see it rise to 2.4 tomorrow. We're expecting that. In any case, in the headline number, we'll have to see a really big surprise in order to have a long-term impact on euro dollar. I'm talking about under 180 or above 250. And the next NFPs, next non-farm payroll releases will be more important because they're getting closer to that December meeting, especially if it's the one in early December, 2 weeks before the Fed decision. Any more questions? Let's put the thank you screen once again. Joe asks, where do you think the EU will bottom after the hike? Well, I would love to say parity because it makes really good headlines. And as a publisher of a website, I need to make headlines. But I'm not sure it'll reach parity. I think can just make this can be a frustrating currency pair, so it can make this false break to a new 12-year low under 104.60, reach maybe 103, 102, and then bounce back up. So I'm not sure we'll see parity. I know some banks like Goldman Sachs and a few others, don't want to say the wrong names, but they're talking about 0.95, 0.98. But I wouldn't go that far. I think currently at 112 we have also falling to 102 will be huge. It's 1,000 pips. And the question, what will happen to euro if no hike in December? Well, euro will go up, but remember that if the Fed hints already in October that it's not sure that it'll hike in December. This can sure happen because the Fed already hesitated once in September. So I believe in this case, Draghi will take the hint, and perhaps we'll see more action from the ECB, because the old continent here needs a lower euro, needs more monetary stimulus. Of course, Draghi prefers that Yellen will do the job for him. As I said, everybody prefers others to do their work, but in this case, maybe we'll have an expansion of the QE program in the Eurozone, not only to infinity, but also higher quantities every month, not 60 billion euros, but even more. Yeah, Goldman's will buy our shorts. at above parity. Yeah, Goldman has a reputation for trading against their clients. That's true. And as an anecdote, also Mario Draghi worked for Goldman Sachs. Also Mark Carney, the Canadian that leads the Bank of Canada, worked for Goldman Sachs. And at least here in Spain, the finance minister didn't work for Goldman Sachs. He worked for Lehman Brothers. So maybe that's good news, no? Yeah. Luis de Guindos, his name is. So I think there's this kind of game between central banks. Well, it's game on big money, of course. And everybody's waiting for the Fed. It's not only emerging markets. It's Mario Draghi. If the Fed hikes, he can sit back and smile. I think Mark Carney in the Bank of England is waiting for the Fed to act first, and then the Bank of England will raise rates, and maybe the same thing for the Bank of Japan. They'll prefer a hint from the Federal Reserve that they'll act so the Bank of Japan can sit on its hands. But and the same thing goes for Australia, for New Zealand. They won't need to cut rates too much if the Federal Reserve raises rates. But if the Federal Reserve tells us that it's cautious, it's worried about China, worried about the dollar, worried in general, we could have this bad mood in markets and more monetary stimulus from basically everybody. More interventions from the Swiss National Bank, you name it. Any more questions? I have 3 more minutes, if I'm not mistaken. So, anyone has a guess for tomorrow's non-farm payrolls? Our good friends at Forex Live have their non-farm payrolls competition. And I guess in many other places, it's always fun to participate and call the wrong number. Well, one time I hit it on the head, but that was rare. Yeah, there's so many changes and then revisions and more revisions, and it's a bit crazy. But it always move markets. Yeah. Okay. Can end. Good news data for tomorrow. I think you're down this run. I hope so too. Yeah, if it breaks down the triangle, it should be because of good news in the United States. More people getting a job, so of course it'll be positive. Also on the human level, not only for markets. Anyway, thank you very much, FX Street. You're welcome to listen to the recording of the show. You're welcome to visit forexcrunch.com. Visit Market Movers podcast, listen to what we're talking. My associate Lior Cohen and myself, follow on Twitter. More contact details right here. And see you. And yet again, I'll talk have the morning show tomorrow at 8 GMT. You're all welcome to join along. We'll talk about what we had in the past day, what's going on next, talk about some technical levels. And thank you very much for the kind words, Joe. And everybody, and see you next time. So thank you, everybody, and goodbye.